What's up, everybody? Welcome back to another episode of the Free and Clear Real Estate Podcast. I am your host, Will Jones, owner and founder of Elevate Title, and your host for this podcast. Today, I have special guest, a good friend of mine, great mortgage loan originator, Kelly Linares from Journey Home Mortgage.
Hello, everyone.
So today's episode, we're going to be talking about mortgages and why your credit score isn't the only thing that will get you the best rate.
Yes, we are. Get
So
ready.
give us a little bit about your background, Kels, just to get us started, who you are, how you got in the business, and then we'll jump right in.
All right, sure thing. I started in the business back in the early 2000s. The reason I started in the business is I bought my house. I had a bad experience. Then I accidentally got a job as an assistant at a mortgage company. And when it was time for me to move up, I decided I wanted to originate, and I decided I wanted to originate differently than how my loan was done. And it's been a great ride ever since.
All right. So having said that, a lot of what I'm learning in this journey of the podcast is that a lot of people get into the business because of a bad personal experience. Seems like that's your story too. How did that play a role, I guess, in making you really want to do this to the highest level?
Woo, okay, so let me start by saying that while I was getting a mortgage, I was signing blank pieces of paper, and I had no idea what my payment was going to be. I had no idea how much money I needed. I didn't even know if I could afford the house that I was buying. It was just this very big mumbo jumbo of things that I didn't understand. And I ended up buying the house. I knew nothing about the process. I didn't know how to make my mortgage payment. I didn't know about property taxes. I didn't know I needed to keep up with my insurance for the house. I didn't know what first place insurance was. So it was just, I became very aware that becoming a homeowner is a lot more than just signing a couple of documents at the closing table. And as I have been a homeowner since the early 2000s up until now, and then being in the business, I learned a lot, and I make sure that I pass that information to all of my clients, because it sucks to be on the receiving end of having an escrow shortage and having your mortgage payment jump from $2,000 to $5,000, and you look around and you're like, whoa, what the hell happened?
Right.
So that's a very big piece of what I do. Like, yes, I originate loans. That's my my bread and butter. It's how I earn a living. But I really believe in education, right? I think if I know something and I share that with you some way, somehow, God and the angels will look good upon me and bless me even more.
Okay.
So pass it along. I guess that's what I believe in.
Okay. So having said that, what I'm hearing is education, knowledge, things of that nature. A lot of people think just having a great credit score, you're going to get the best mortgage rate or the best deal or the best whatever the case may be. Is that always the case?
Okay, so I love credit scores and I love mortgage rates, because those are the main questions that I get asked over and over and over. And interest rates are very important because they drive your payment, right? So if my interest rate is 8%, that really sucks. And if I have a really low credit score, I may not be able to get a loan. However, a credit score, it's not the only thing that is going to guarantee that you get a better deal or a worse deal. There's a lot that goes into a mortgage loan. A credit score is a component. It is a driver that drives a lot of the steps during the process, but it's not the only one.
Okay. So what are some of the factors that go into a mortgage approval, loan review process that the lender is looking for outside of the credit score? Once you got past that credit score, say, okay, they have a bad credit score or they have a great credit score, that's not the end of the picture. What are some of the other things that you're looking for during the approval process?
Okay, so let's say that you call me today and you want to buy a house, right? We have a conversation. I may ask you, what do you think your credit score is? Yada yada yada. What are you looking for? From then, if you have a credit score that is at least a 580, I know what type of loan I can put you in. Probably an FHA loan, right? If you have a higher score, maybe a conventional loan is going to be cheaper for you. When we are putting together a loan approval, there are several things that go into your credit score, your down payment, the property type, what kind of property you're buying, your debt to income ratio, okay? Depending on the type of mortgage that we are going to go with, if it's FHA or conventional or VA, your mortgage insurance payment also plays a part. So you combine all those things. That's why an approval is not going to be the same for everybody. Like everybody has a very specific need and very specific information to their situation. So yes, your neighbor may have purchased the house with an X interest rate, but you may not be able to get the same interest rate because there is a lot that goes into putting a loan together.
So mortgages, to equate it to something somebody or everybody should understand, is kind of like a fingerprint. No two mortgages, even though you may have a conventional, I may have a conventional, our two loans won't be the exact same.
Yes. So there's a lot that goes into. Think of a waterfall when I think about putting a loan together, right? It's a waterfall. First, we pull a credit report, a tri-merge credit report. We get 3 scores, we go with the middle. And then after we pull that credit report, we know your debts that are listed. Then we review your income. Then we have an idea of how much house you can buy. And then we want to find out, do you want to do a down payment? Do you want to do down payment assistance? Do you want to finance 100% of the purchase? There are different programs. And then we go and apply that program differently depending on your needs. And then at the end is your packaged loan.
So when it comes to clients, because I hear this on the real estate side a lot, oh, well, my neighbor got so-and-so credit, so-and-so loan type, I want the same loan or I want the same interest rate. That's not true. That's a myth that it doesn't work just like that.
Yes. So that can be a very big myth. Each person's qualifications are going and needs are going to be different in different scenarios. I would say that if you are in the market or if you are planning to buy, I would schedule a phone call with an amazing loan originator, okay, who's going to educate you and spend time on the things that really matter. Because it could be that you are a very organized person and you take care of your credit and you save money and your life is structured, and we have a conversation and 15 minutes later I have an approval in hands to give it to you. You go the next day, you find a house, 30 days later, 21 days later, you are closed. There are people, because they haven't been thinking about buying, they haven't been putting money away, or they maxed out their credit cards. So before you do anything, I would say at least 3 months out, talk to a loan originator, okay? Somebody who's gonna help you design a plan for you. Because it could be that today you don't have enough money saved, or that today you maxed out all of your credit cards because you went on a vacation and you just maxed out the credit cards. Maybe you need a little bit of time to pay those balances down so you can get a better score, which is usually what you have. So because the credit scores, they fluctuate as you spend and as you pay. Right? So very important, before you do anything, at least 3 months out, talk to a loan originator and then design a strategy that fits you and your needs.
What's the biggest myth that some of your clients come to you with as far as the mortgage process, like how it goes, how long it takes to close? Like what that you hear over and over again that is just so off reality that you want to share with everybody, so they don't come to an amazing loan originator like you with the same myth that just isn't true?
Okay, I think a lot of people are scared to look at their finances, and a lot of people don't even make the call. They don't make the call because your credit score is 580, or they don't make the call because they look at the savings account and there is $1,000. And that keeps them from buying for years and years and years just because they are scared to make the call. The people that do make the call, most of the times they find out that it's easier than they expected. And to every problem, and I mean it, okay, to every problem there is a solution. There is a solution to fixing your credit. There is
Bankruptcy?
well, no, we're not going to go there because if you file bankruptcy, you're going to be in trouble and be able to finance your loan with a conventional loan. I mean, I can give you another loan that is more expensive, but save yourself money, don't file bankruptcy.
But you just said it. You can give them another loan that's going to be more expensive. So
Yes.
it might not be something that they want, but there is a solution to almost every problem.
Yes.
It just might not be the solution that you like or one that you necessarily may want to afford.
But you're not going to know unless you design a strategy for you. I think the number one thing is making the decision. It's making the decision that you want to own your own home, or it's making the decision that you want to slowly start to buy your first home and then maybe the second home. You need to make the decision. Once you make the decision, everything else will fall into place. We come up with a plan. We work on it for a month or 2 or 3, or we find you alternative financing or different type of loans. Trust me, if you make the decision, there's a way to do it. And I'm very good at finding the way. I would just like to say that.
That is true. That is true. So let's pivot a little bit and kind of navigate back to credit score.
Uh-huh.
What does a credit score tell a lender about that person? And does somebody with a great credit score, can they still look risky to a lender?
Yes. So think of your credit score. When I pull your credit score, we take a picture of your financial situation, right? I press a button and everything that you owe, your payments, balances, everything is there. That report then goes through a software system that all lenders use, and then it reads the information, and then it tells me whether or not they want to give you a loan. And I'll give you an example, and this happens all the time. Let's say that you are new to credit. You just started building your credit 2 months ago. You have one Capital One credit card with a $200 limit, and you have a Visa card with $300 limit. One of them is maxed out because the limit is so small, but one of them is maxed out, and you have a 680 credit score. A 680 credit score, it's a really good credit score. But in reality, there's no credit history. You don't even have 12 months of credit history. So yes, you could have a 700 credit score, have 3 small credit cards there. There's only been reporting in your credit for a few months, and that may be an issue. But however, let's say that although you're just building credit, you have been saving money for many years. So you have what we call cash reserves. So sometimes the lender will do like checks and balances and say, or the system say, okay, this person's credit score is new. However, they're going to do 20% down payment. There's less risk for me. I'm still going to lend you money. So you see what I say about waterfall? Every deal is going to have its own little nuances, and it's just putting it together.
So what I'm hearing is there's technically almost no such thing as a bad buyer or a bad borrower, because you may be lacking here, but you may make up for it over here, and the banks will look at that and say, all right, well, they might not have a high credit score, but they have a lot of money and good payment history, so they're not risky. Or they may have a great credit score and something else might be a little bit off, and the bank says, okay, well, we'll take the mitigating factors and kind of wash it out.
Yes.
And approve them.
Yes. So every deal has a layered risk for the lender. Obviously, if you have a 100 credit score, that you've had for 10 years, and you have $100,000 in your savings account and doing 20% down, and all those things are going to look good to the bank. And you can have all of them together. We call them the vanilla files because everything is so perfect. I mean, you just wish you just be in a vanilla world 24/7. But the reality is that we are human beings, and we do
have challenges and
yeah, we
issues.
have challenges. We do the things that we do. I've been there. There was a time in my life my credit score was 450. I am no longer there, but there was a time, long time ago, that my credit score was 450. But going back to the point is, there is layers to every file, and the lender is going to look at every layer. And then, before the next question, because there's one change that came out that is really big. So FHA announced that, so right now, all lenders across the country, we use the classic FICO score. So it's the classic FICO score of reporting the information. Or for Tri-Merge, we get that information. There's other ways of collecting information. There is Vantage Score. There is the FICO trended data. So basically, within the credit report, they're just looking at different things, right? So FHA announced that they are going to be accepting Vantage Score and FICO trended data. What that means is that for the first time home buyers, people who are renting. So let's say that your credit is like, I don't know.
450?
450. But you have been renting this property for 5 years, and you have been paying on time for the past 5 years. Right now, this information doesn't really matter because it doesn't go on your credit report. With the Vantage Score and with the FICO trended data, your rent payments are going to be reported, and the lender is going to be able to look at an even better picture. And people who before wouldn't qualify because they didn't have the acceptable trade lines, we can add that information in now and get them approved. So that's coming up. It was just announced. That's going to change the game for everybody, especially first-time home buyers.
Is that something, you might not know this, is that something that the landlords are going to have to report to their credit? The borrowers are going to have to say, hey, I'm a renter, this is my rent. Can you include it, or how does that
right now, if your landlord, depending how big they are, they can report that to the credit bureaus, or you can collect the information and send it to the credit bureaus and have that added to your credit report. But as we start using Advantage Score and the trended data more, that's going to expand. So we'll see how that information is going to be. But right now, you can manually add your rent information. You get a verification of rent, and then you can send it to the credit bureaus and get that information placed on your credit report. Yeah, that's
verification of rents, people.
Yeah.
Make sure you get it.
Yes, it's going to be a big game changer, I think.
As far as credit scores go, is there a point, everybody wants to have, 850 is the perfect credit score?
Yeah, maybe if you have 800.
Every time it changes. But everybody wants that perfect credit score, as high, closer to it. Is there a point where your credit score stops being advantageous? Say at, 800, your rate doesn't drop any lower than this, or 820 or 840 or 750. So at 760, you max out all of the benefits of a great credit score.
Yes. So when you price a loan with a lender, you have your credit tiers, right? You have your 620, 640, 650, 680, 700, 720, 740, 760 is the last stop. So whether you have a 760 credit score, you have an 850 credit score, you're going to get the same thing.
So really, people, when they say they have an 800, it's just a flex to say I have an 800 credit score.
It's a nice flex. I don't have an 800 credit score. I have a 760.
I mean, so you still max out at the top. Okay, that's fair enough. Do your clients typically put all of their concern on a credit score? Or do you see, clients' main focus is, I have to have a 700, or I have to have a 720? Or do they pay attention to say, hey, I have to have a good credit score, I have to have money saved, I have to have low DTI. What do you find is typical with
So-
people you deal with?
So what I find in my conversations with people is they come in really worried about, don't pull my credit. If you pull my credit, that'll be Armageddon.
I'm going to lose 10 points.
So people are very scared about pulling credit for a mortgage inquiry. And most of the times, okay, when you apply for mortgage, you pull a credit report. That credit report is good for 4 months. Remember, you take a picture. So it doesn't really matter if your scores drop by 5 points after I pull my credit report, because I'm going to use that credit report for the loan. We're not going to repull it. That's going to be it. So it doesn't really matter if you let me pull your credit or not. I cannot give you approval without one. So people are really, really scared of having their credit pulled. But if I don't pull your credit, we don't know what we have, so I can approve you. So you see where I'm going?
Do you issue pre-approvals without pulling credit?
Absolutely not.
Okay.
Absolutely not.
Have you ever had clients ask you, just give me the...
All the time. All the time. And it's not that I'm trying to be difficult.
Tell people why you don't want to do that.
It's not that I'm trying to be difficult. You come to me. You want me to give you a clear financial picture of the biggest financial decision in your life. Along with that, there will be other people involved in the transaction. You're going to have a real estate agent that's going to go up and down and putting 100,000 miles on their car showing you houses. You have a seller who's pulling their house from the market and paying a mortgage payment while we're doing your loan. You have a title company who's spending money before anything, and then your time, and then everybody else included. If I give you an approval only based on the verbal information that you give to me, and that approval goes out there and you go on the contract, and I cannot close your loan, I am being irresponsible with you and everybody else involved in the transactions. So there are people out there who will do a verbal approval. They call it a pre-qualification. I don't believe in that. I believe in reviewing all of the information up front so we can come up with a plan and being very transparent with everybody. So if you come to me, expect that I'm going to ask you for documents, that we're going to pull your credit, and the approval that I'm going to give you is very solid, so that nobody involved in the transaction wastes any time, especially you, because you don't want to fall in love with a house, spend 30 days spending money, appraisal and inspections and everything, and at the end of the process, I tell you, oh, oops, we never put your credit, or we never verified your income, and you don't qualify for this house. So,
and that also puts their earnest money deposit at risk.
Yes, so you're gonna put in some money deposit with a contract, and if you cannot get a loan, bye your money. So I am very, very strict on that. Everything up front is for your own good and my own good too, because I don't like to waste time.
We actually have a property that we're selling out on the West Coast, and everything went good. It was a 28-day closing. It was supposed to close the end of last month, and 2 days before closing, the agent calls me and says, hey, we're backing out of the deal. Why are you backing out of the deal? Oh, the borrower's losing their job and they won't be able to get financed. 2 days before closing. These things happen, and you know what happened to their earnest money deposit?
Gone bye-bye?
Gone bye-bye.
Ooh, that hurts.
Gone bye-bye.
Gone bye-bye, that hurts.
And I'm sure they didn't intend to do it. It's sometimes these things happen.
Yeah, life happens.
Where, that was out of his control, but not getting your credit pulled up front, not reviewing your documents up front, that is in your control. So it's okay. I'm not gonna say it's okay to lose money, but when it's out of your control, it's an easier pill to swallow than when your lender didn't do their job correctly. And you as the consumer or the borrower, you didn't know that you should have your credit pulled, that you should provide these documents to protect yourself, your escrow deposit, and your time for that fact.
Yeah.
All right. We're talking about mortgages. Let's talk about rates, mortgage rates. You love talking about mortgage rates. What goes into?
I hate high rates. They make my job very hard, very hard.
COVID is long gone. What goes into determining a rate that actually like the market rate? Because a lot of people, are sitting on the sidelines right now saying, "Oh, I'm going to wait till the rates drop. I'm going to wait till the rates drop." But they have no idea how the rates work, when rates are going to drop. They watch for Jerome Powell or whatever the next Fed chair is to say, "Oh, we're dropping rates a quarter point," and then as soon as they see it drop, they want to call and say, "Hey, rates dropped today a quarter point. I'm ready to do it." Is that how it works? What else goes into it?
Okay, so there's a lot that goes into the final rate that you receive in a mortgage loan. Remember at the beginning I said a waterfall? The waterfall is the following. You're buying a house, you have your credit score, you have your income that determines what your debt to income ratio is, your DTI, you have your property type, single family home, a condominium, all those things, they add hits to the rate, right? With a lender, we have something that is called the par pricing, which is the wholesale rate. That's the rate that costs the bank to lend it to you. On top of that, the bank is going to layer the risk of lending you that money. That's what I'm talking about. The waterfall is the credit score, is the down payment, is the property type. So once you layer all those things, then you get hits to the rate. And the final product, which is the retail, which is the rate that everybody gets, is already adjusted for the risk from the lender. So that is your final rate. Hence what I said about every person is going to have something different that applies to them. Right now, rates are they were getting really good in the low sixes. And then with the conflict and everything that is happening, oil prices, inflation, all that good stuff, rates went slightly up. I think it's kind of stable for now. And we can sit here and talk about rates all day long.
Next episode.
Yes, but there's no way of knowing what's going to happen tomorrow. Like rates were getting great. Like I priced a loan at 5.99. I could barely contain myself. The following week, we have like the whole world is on crisis and rates go back up. There is no telling us, everybody here. Like we don't have a crystal ball. Yes, you can look at the past and see where the trends are going, inflation, and have an idea of what interest rates are going to be, but nobody can say anything for sure. We only have the present. At the present moment, rates are in the mid-6, which is still decent. Ideally, I would like to be in the 4s and the 5s. I don't know when that's going to happen. Hopefully the conflict ends and our economy gets, a little breathing room with inflation and that gets better. But if you were sitting on the sidelines, okay, so the main question here is, do you need shelter? Right? We all need shelter. Mm-hmm. You can rent, you can own that shelter. You can buy a house that you can barely afford, or you can buy something really cheap. It's your decision. And you can sit on the sidelines. And I have a client that's been sitting on the sidelines since 2017. 2017, okay? A house that they could have bought for $125,000 back in 2017 today costs $600,000. So please don't be that person. Eventually, no, you need shelter. So you're either gonna rent, you're gonna buy. The question is, do you wanna do it now? Do you want to buy it now? Because rates are going to do this always. And prices tend to fluctuate. So even when prices adjust and go down, they eventually come back up. I have been through every single market you can think of. I bought at the bottom of the market, at the top of the market. I had a 12.99 interest rate on my second mortgage at one point. Whatever you can think of as far as in this real estate market, I have experienced. But what I have learned all these years as a homeowner is real estate is not a fast game.
It's a long game.
Is the long game. So you buy and you hold. You buy and you hold. And that is the only good advice I can give you because that has actually worked for me.
But you're also a little small flex. You're also a real estate investor. You're up to 3 houses now that you own. And it didn't start out as being an investor. It started
I'm not an investor. It's opportunity. Comes
you have
along.
you have investment properties that makes you an investor.
Yes.
Yes, so you are an investor. Own it.
Well, but
Accept
the
it.
thing is, people get intimidated with that word, right?
Well, that's because they don't know. They don't have the education to understand what it means to be an investor. Which, by the way, next week's episode we'll talk real estate investing. Nice plug.
Shameless plug.
Shameless plug. But so what you are, what I call or what I would consider is a house hacker. It's somebody who buys a house, who lives in it for a few years, fixes it up to their liking, and then they move on to another primary residence. They do the same thing with that residence, and then they move on, and you're building equity, and maybe you cash out and make a bigger down payment on your next house, or use that money to invest to buy another one. We'll get into that next week, but that's what you do.
It's very attainable. It's very attainable.
If you can buy one, you can buy 3.
I didn't have hundreds of thousands of dollars. I bought my first house. It was ugly. I love ugly houses. I lived in it. I fixed it up real nice.
Made it really nice.
And then I bought my second one. It was ugly. I fixed it, made it really, really nice. Now that house, I bought it right before the mortgage crash. So that house, I lost it to foreclosure because I didn't have anybody advising me. If I had me back then, I would still have the house. And then I bought another one, and then another one. And it's not like I'm making huge investments. I buy them with the minimum down payment.
Because you're buying them as a primary investment.
I'm buying them as primary. I live in it. I live in it through construction. I always say I'm never doing this again. I'm buying a brand new house and then I do it again. Why? Because it works.
Yep.
Because I have been able to build wealth in a way that it wasn't available, not even in my wildest dreams.
It's so much harder to build it outside of real estate.
Yes. I don't know nothing about the stock market. I mean, I'm in the mortgage business, and if I see a good house, I buy it. I go live in it. I fix it up real nice, and then I go to the next one, and then hopefully by the time I retire, I'll have a little chunk of money.
You mentioned something earlier that I know from being in the business, and people that are watching that are in the business probably know, but a lot of homeowners have either heard it and don't know and are too embarrassed to ask, or they just don't know and don't care to ask. DTI, debt to income ratio.
Yes.
What is that? How does it affect your rate? How does it affect the mortgage approval? Like, explain that to people who may not know what that is.
Okay, so your DTI is your deal killer. Your DTI, your debt to income ratio determines how much money you can borrow and how much payment you can afford, right? So the lender will use your gross income, not your net income, your gross income, and divide that by the proposed house payment, whatever you're buying, and whatever is in your credit report. Car payments, minimum credit card payments, whatever is listed on your credit report, student loans, stuff like that. Mm-hmm. So that gives you a percentage, right? And each different loan program has their number. For example, FHA, you can go as high as 4757. That means that if you're
47 and 57, what is? Okay. I know what that means, but
sorry. So your front end DTI, which is just your mortgage payment. So if I grab your mortgage payment and divide that by your gross income, it gives me your front end DTI, and
that can't exceed 47.
And then everything else, which means the housing payment, whatever else is on your credit report, cannot exceed 57. So for people with less income, I would definitely put them on an FHA because it gives them more buying power. And for conventional, between 45 and 50, that depends on your credit score. So 45, 50 total. So your proposed housing payment and whatever is on your credit report divided by your gross income, that number cannot ever exceed 50%. So that is your debt to income ratio. Your debt to income ratio determines how much house you can afford. Now, with that being said, you should have your budget. Stick to the friggin' budget, okay? You don't want to be, what is it that they say?
House rich and pocket poor.
Yes, please don't be house rich and pocket poor.
You heard me talk about that on last week's
Maybe
episode.
you don't need a 5-bedroom house if you're going to live by yourself. I'm just saying. You could have it, but unless you're making millions, maybe you buy a 3-bedroom house.
But so I'm sure you get this a lot where people come in and, you're not pre-approving them necessarily based on their desires. You're looking at the total financial picture. So you say, okay, you can afford $1 million house. Then from that point, it's the next conversation I imagine would be, okay, what are you comfortable spending a month? Because even though I may qualify for $1 million, I might have a lifestyle where I travel every weekend. And now paying $10,000 a month for a mortgage payment cuts into how many times a month I can travel. And I may not want to spend $10,000. I may want to go $5,000 a month is where I'm comfortable at, and that might drop my loan approval from $1 million to $500,000-$600,000. Is that smart? Do you see that often? Do you have that conversation?
Yes. So the way that I see my job is to give you the facts, right? And at the end of the day, you make the decision. So what I usually tell the clients is, I am always going to tell you the max that you qualify for, followed by what are you comfortable as far as a mortgage payment, and then we can have a conversation. I'm not going to push a mortgage payment or price on you because it's your life, your decision. I am just going to give you the tools and the knowledge so that you can make a very informed decision for your life. Because you may start your mortgage payment one way, but remember, the mortgage payment is more than repaying the mortgage. You're going to pay taxes, you're going to pay insurance, which is called the escrow account. And your escrow account will change over time. The majority of the mortgages that I do is a fixed rate for 30 years, which means your actual payment and interest payment will not change. But over time, your taxes and your insurance will change, which will affect
the
your
total
payment over time. So I also make sure that I prepare my clients for that change. And I just think that if you have enough information, you can make great decisions for your life. I believe in you.
All right, so let's get into some nitty gritty, like bank stuff, like in the business stuff.
Behind the curtain.
Behind the curtains, yes. Wizard of Oz.
What do you want to know?
Loan level price adjustments.
LLPAs.
LLPAs. What are they? Are they important? I don't even know if a homeowner is ever going to hear this word.
Probably not.
But I promise you, if you drop this word to your loan originator, if it's not Kelly, first of all, you should be ashamed of yourself. And if it is Kelly, she's going to know you watched this episode, and she's going to explain it to you anyway.
I approve this message. Okay, so LLPAs, loan lender price adjustments. LLPAs basically is all of the adjustments to the interest rates before you receive that rate.
So kind of goes back
So
to that
going back
waterfall
to
scenario.
your down payment, your debt to income ratio, your property type, all those things are layered risk, and that layer risk turns into hits to the rate. So the loan price adjustments go into that. So it's basically grabbing your loan, looking at it, finding how much risk you are as a borrower, and then adjusting your rate according to the risk. And all lenders do it. That is why it's very important to be prepared at least 3 months out to have the best credit or the best plan. If you have a good plan, you can escape some of, the behind the curtains extra expenses.
Are rates negotiable?
Everything is negotiable.
Okay.
Everything's negotiable. Okay.
So if somebody came to you right now and said, I want a 2% interest rate, like it's still COVID outside.
I'm sure there's a way to do it.
Oh.
It's going to cost you. It's not going to be free.
Oh. So everything is negotiable.
But there's a price. Everything is negotiable, but there's a price.
Okay.
Yes.
So what does that price look like?
It depends. It depends on the scenario for each person. It's impossible for me to sit here and price a scenario because there's so many questions that go into it, right? I get phone calls all the time that says,
Oh, well, I have a scenario right here. We can.
I get
kidding.
phone calls all the time that said, what kind of interest rate would I get? Well, then I start asking the questions, and sometimes people get annoyed, but I have to grab the information. I have over 100 lenders that I can go in and price your loan depending on your need. Do you want to close fast? Are you going to be annoyed if we go to this lender that offers the best rate, but then we're going to be inundated with paperwork and we may not close on time? There's a lot of things. There's a lot of lenders out there that offer different things.
I like how you segue into my next question without even knowing.
See?
Bank or broker?
Oh, broker all day, every day. Duh.
Sorry, bankers.
I mean,
Explain why.
Not to take away from the bankers. Okay, so a banker works for one institution with one set of guidelines, and they have one product. I mean, they may have different products, but they are going to find the bank standards and guidelines. When you go to a mortgage broker, we work with wholesale lenders. In this case, hundreds of lenders with different guidelines, with different requirements. So if you come to me with a deal that doesn't fit ABC mortgage, I can go to X, Y, and Z mortgage. Or I can look around and get a roster and look until I find somebody. And then in addition to that, because the way that I do business, there's a lot of wonderful brokers in this business. There's a lot of people who've been doing this for a very long time and they're very passionate about it. And I just happen to focus a lot on education and being prepared. And I really take pride in offering a really good product to my consumer, right? I get really happy when somebody understands the process and they understand their loan. I get a kick out of it. So each person is going to have a different flavor of doing business. Find the one that suits you best, but definitely go with a mortgage broker. Absolutely.
And if you're a banker selling mortgages, go work for a broker.
Yes. Call me. Call me.
No debt, bigger down payment.
No debt.
No debt.
Yeah. All day, every day.
All day, every day?
Mm-hmm.
Twice on Sundays?
Oh, heck yeah.
Okay. Do's and don'ts.
Okay.
What do you see happen, or what have you seen happen that can kill a deal? And what it is that people have done, and what are some of the things that people don't do that can hurt them or negatively affect their amount or approval?
Let's have a serious conversation.
Oh, it's serious.
Don't do. Okay, obvious. Don't quit your job, please. Or if you are going to quit your job, let your loan officer know before you do and find out what kind of job you're going to get after that. Don't buy crap before closing. Don't finance a car. Don't go buy new appliances.
No furniture.
Don't go to the furniture store. Don't buy anything.
So basically what she's saying is once you sign the contract to buy, or you commit to a refinance, that's it. 30-day pause, 21-day pause, 14-day pause, however long it takes the lender to tell you you're going to close. Credit card is off. Don't spend any money.
Oh, another one. This is in your wheelhouse. Don't make changes to title if you're in the middle of a refinance. And if you're getting a divorce, let your title agent know.
Please. I say real estate is kind of like the doctor-patient relationship.
Yes, it is.
The doctor can't cure you if you're not honest with how you're feeling. As a title company, as a loan officer, as a real estate broker, as an investor, give them the picture. No matter how bad you think it is, like she said, there's usually something that you can overcome.
Better call Sam.
Better call Saul.
Oh, Saul.
Saul, better call Saul.
You give me the picture, the whole entire picture. We'll figure out how to do.
Correct. If you give all of the information, then she can say, hey, I don't think we can do this. Or we can do this, but we need to do A, B, C, X, Y, Z. Yeah. So don't be afraid. If you've had bankruptcy, I have. If you had a foreclosure, I have. If you've had a 450 credit score, she has.
She had. I'm 760 now.
Mine's been pretty low before. Never 450, but it's been pretty low.
I was in the good.
But I've owned several houses. I flipped several houses. I own cars. Like some of these things, there's never anything that's bad enough that puts a black eye where you can no longer afford to buy a house or a car. But we need to know, as your professionals and your team, what is the situation so we can best advise you on how to move forward with that situation.
Absolutely.
What are some of the do's?
Oh, some
positive
of the do's.
stuff.
Ooh, there are so many. Have a very realistic budget for your life. Don't live above your means. Watch how you spend your money. Money is a wonderful resource that you can use well or use really badly. I've had clients who made fortunes and they were poor because they spent every single dime. Check your credit regularly. Download a free credit monitoring, Credit Karma, whatever it is. Not to know your scores because their scores suck, but you can see your balances, you can see what's coming up. So pay really close attention to your credit. Have a plan for your life, right? Have a plan on when you want to buy something, and take some very important financial decisions for yourself. I think it took me a while. I started young and I was a little stupid and I made stupid mistakes and I ended up with a 450 credit score. And then I had to pick myself up and figure out how to do it. And it wasn't nice, and I had to pay collections and I had to work and I couldn't spend money because I didn't have money. But from that experience, I learned how to save, I learned how to budget, and it changed everything for me. And if I hadn't had that very bad experience with my credit score, I was 450, I would have never learned how to budget and to save and to treat money as a resource, not as this emotional thing that we think about. Money is just money. It comes and goes, but it's better if you have a lot. So
I would agree with that.
Money is really good. It's a great tool. It's a great tool when you have an emergency. It's really empowering when if a family member needs money for a medical bill and you can just send them a Zelle because nobody else writes a check. So that's very empowering. So I would say financial literacy is the number one thing I wish everybody would get and focus on, because that can be life-changing for you and your family.
If there's one thing from this episode that if you had to sum up, if somebody said, you know what, I don't have 50 minutes or an hour or whatever this is going to be to watch, but I need to get something out of that episode, what's one thing that you could tell them that would be like, that episode was worth it?
Okay, Make a decision for your life, whether that is to buy a house, whether that is to improve your credit score, whether that is to save money or how to spend money. You are responsible for yourself financially and sometimes for your family. Just take responsibility. And once you decide, everything else is going to work out. So once you decide, I no longer want to be on the sidelines, I want to buy my house, make a phone call, come up with a plan. From there on, everything else we can find a solution for.
I like that.
I like that too.
I'm going to end my part with saying something I wanted to say earlier, but we kind of went off on a tangent. And this might help people get off the sideline in order, or in reference to what you said. I truly believe that nobody pays rent. It's my personal opinion. You guys may agree, you guys may disagree. There is nobody that pays rent. You either pay your mortgage or you pay somebody else's mortgage. That's it. Either you're going to build wealth for yourself or you're going to pay rent and build wealth for somebody else. So when you think about it like that, I think more people will get off the sideline and say, hey, why am I making Mr. Landlord rich when I could be making myself rich or leaving wealth for my family or my kids or, you know, family members, whatever the case may be. So my advice is to take her advice. Get off the sideline and buy a house.
Make a decision. Do it. We'll help you.
Because I can tell you, I've known her for a long time, and she used to be the same thing. Like, I just want to work, I have my rent, whatever the case may be. And now every time a house comes on the market, she's like, oh, let me run numbers. Should I buy this house? Should I buy this house? Oh, my daughters are in college. I'm going to look to buy a house there that they can rent it out and make money. She has grown tremendously as she's progressed in the business, from just being a homeowner to now having a mind shift of switching and putting on the investor hat and looking at everything not as a transaction, but how can this be a catalyst or a catapult to take me or my clients to the next level. She even does the same thing with her clients. After they buy their first house, they call her 6 months, a year later, oh, have you thought about buying an investment property? And then she starts that journey with them. So great having you on today, great conversation, great loan officer, probably even a better person. They kind of right there neck and neck. You're a great person, but you're a really good loan officer too. So they kind of up there together. Tell everybody how they can reach you, social media, phone number, email address, the whole nine, because we want to get you more business so everybody can experience the glory of Kelly.
Oh, thank you, William Jones. So my name is Kelly Linares. I am a mortgage loan originator for Journey Home Mortgage. You can find me online pretty much everywhere on Instagram and TikTok. Home Loan by Kelly. I am on Facebook, LinkedIn, YouTube. You can Google Jean Kelly Linares, find my website. I am everywhere. Give me a call. I would love to work with you. Thank you for your time. Thank you.
In order to give her a call, she'd have to give you her number.
Oh, shoot. 954-624-2095. But they can Google me. I'm everywhere. This face is everywhere.
That's an extra step for them to do. Just give it to them.
Thank you.
All right, everybody. Thanks for joining us for another episode of the Free and Clear podcast, where we cut through the noise and talk all things real estate. This has been another episode sponsored by Elevate Title, which I am the owner and founder of. Send us some business, if you will. Like us on social media, follow us, and look out for new episodes every Wednesday on YouTube. See you soon.